Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today, we're continuing our SEC Focus series with a look at another top comment letter area in 2025, management's discussion and analysis, or more familiarly known as MD&A. Investors rely on MD&A to understand how management views the company's performance, future trends, uncertainties, and more. So it's no surprise that MD&A continues to be a frequent area of SEC staff focus. Joining us for today's episode, I'm happy to welcome Lindsay McCord and Ryan Spencer, both partners in PwC's National Office who work extensively on this topic. And for those of you following along with the series, our guest host once again today is Kyle Moffitt, PwC's National Office Professional Practice Leader. Kyle and Lindsay both spent nearly 2 decades at the SEC, so also bring that firsthand perspective to this conversation. Let's go ahead and get today's episode started.
Ryan, Lindsay, thanks for joining me for this next episode on SEC Comment Letter Trends, where we'll dive into management's discussion and analysis, otherwise known as MD&A. I know the two of you spend a lot of time with our review teams and clients focused on comment letters from the staff, and MD&A continues to rank in the top 5 of SEC comment letter trends. Lindsay, can you start us off just providing an overview and some of your perspectives on the overall trends and frequency of SEC comments related to MD&A?
Sure, Kyle. And again, thank you for having me. So over the rolling 12 months ended September 30th, 2025, we've continued to see MD&A SEC comments be high volume, number 2 in the top 5 overall, not based necessarily on sector. Sectors tend to see the same where it's number 2, maybe a few sectors, it's a number 3 area. But I wouldn't say that this is a surprise or a change from anything else. This is something that we've seen a high volume of comments for several years now. And it's something that, Kyle, both you and I are aware that it's not only something that the SEC accountants review, but you have SEC attorneys reviewing. So that could also play into why you might have it as a higher comment volume. But again, kind of going to the data piece for the last rolling 12 months. And even, when I just isolate and think of the SEC comment letters that were issued in 2025 here, which we know there's a lag when SEC comment letters are issued. The SEC staff reviews a filing. Then once they close out that filing review, it's normally on average 20 business days until you see the comment letter. So there's always that lag. So things released in 2025 might have been issued in 2024, but we've overall seen an increase in MD&A comments as a percentage of total comments. And just year over year, the number of MD&A comments, which I find that interesting. And I was kind of trying to sparse the data to say what is driving that. And some of the things that I notice, we have a lot of crypto companies that possibly were reviewed in prior years, maybe 2023. And those comment letters weren't released until this year. And they had MD&A comments. And you had other type of sectors and companies that had a delay in the release of letters. So that could be skewing the population when we say the numbers, the volume's up in MD&A, because really you're not thinking that that relates to 2023 10Ks or even 2022 10Ks. But then also another thing that I found interesting was that there was shift in other topics where letters went down. So when in the total number of letters on that rolling 12 months, the denominator in your calculation went down too. So that's why, again, MD&A, I wouldn't say that I feel like it's a trend that it's up, even though the data is telling us it is. But again, looking at the information, it seems like there might be other factors playing into that. And it's probably actually flat when you exclude those factors year over year.
Yeah, no, I think that's interesting that you point that out. The timing obviously does matter, right? When they release these reviews, the comment letters. I think you'd expect, I guess, moving forward, you'd probably expect maybe to see a decline potentially because of a new focus from a new administration. I think it'll be interesting to see how it plays into, when you think about the shutdown, right? It was a lengthy shutdown. And they're going to be really fast and furious trying to get through all the required Sarbanes-Oxley reviews. Does that then mean that we see fewer comments on things like MD&A? Because they got to focus on getting the financial statement reviews done for them to meet the Sarbanes-Oxley mandate. So I think it'll be interesting to monitor this space. I think we may be coming back to next year and saying, hey, revisiting this conversation. And I think it segues nicely into diving a little bit deeper into the specific, comments that have been issued. And Ryan, I know you were on this podcast last year to discuss the topic. Are we seeing anything new in terms of kind of the specific areas that the staff's focused on in MD&A?
Yeah, Kyle, I'll start high level with just the various sections of MD&A, and the rest of the discussion will kind of follow how the rule's organized. So the actual rule is organized, I like to say, in kind of 3 buckets. You have required disclosures in MD&A around the results of operations. You have liquidity and capital resources, as well as critical accounting estimates, and we'll talk about all of those areas. But just looking at those 3 areas, Kyle, the one where we see the most comments, and this is fairly typical and it's been this way for a while, is the results of operations section. Mm-hmm. That by far and away outnumbers the other 2 areas that I mentioned. In fact, results of operations is about 2/3, and that's about what it was last year. So we aren't really seeing any shift there. But we'll talk a little bit about some of the specifics in each of those areas and where there might be some shifts or some future considerations. But overall, that's pretty consistent.
Yeah, I think it's interesting, right? I think obviously when you talking about those buckets, right? I think the first thing that people really do think about is results of operations. I know Lindsay, when you used to review filings, it probably was the first area of focus. You're looking at a financial institution versus some other companies in different sectors. Obviously, the focus may change, but as you think about, as we're thinking, Ryan, about some of the complexities in that space, like what's leading to more comments on areas like results of operations, or is it just the fact that people aren't paying attention, or they're just kind of going in bare bones with, hey, there's an increase due to this or that, and not really getting into the details? There may be some things that are offsetting. I'm not doing air quotes, but I'm kind of showing up and down different impacts on different line items and positive and negative impacts. What's the reaction? Results of operations, it gets the most comments. I always like to look at it as just because there's a lot more to unpack there. There's just a lot more to discuss. You've got required disclosures at the consolidated level. The rule also requires it to be, I'll say, disaggregated to the extent that that's material information, disaggregated by segment or geographic area or whatever cut makes sense. But usually it's by segment. So you have those types of those types of disclosures. If you're doing an interim period and you have year-to-date and quarter-to-date periods to discuss, so that's additional disclosures in the results of operations. And then the other thing I think that causes a fair amount of focus in this area is that there's a lot of the disclosure that's forward-looking in nature. We'll talk a little bit more about that in detail, but requires companies to look closely at some of the trends and uncertainties and talk a little bit about what they are observing and what might impact the future. In other words, what might cause the future results perhaps to differ from the current results. So when I look at that, plus with all of that comes a lot of subjectivity and judgment in finding the right level of detail in the disclosure. It's an area that just naturally generates the higher level of comments. There's also just a lot of source material for the SEC to look at when they're evaluating and reviewing the MD&A. Talk a little bit about that source material. What are we seeing the staff focused on? Well,
when reviewing the MD&A for compliance, the staff, it's fairly obvious through the comments that during a review they'll look at the company's other parts of the document as well as other publicly available information. So think about quarterly press releases, earnings call materials, investor day materials, all of that information, which generally is publicly available. Not to mention the other information in the filing accompanying the MD&A, like the risk factors section, business section, and other parts of the filing. So able to triangulate and get a better picture of what's going on or what's the company's story that they're telling externally, and how does that match up against the MD&A when talking about the results for a particular period.
Yeah. So what are some of the common themes that we're seeing, at least, with respect to results of operations?
Yeah. So the most frequent comment is around what I like to call quantification of changes in results. So most frequently, the staff is requesting or asking companies to indicate how they've considered disclosing, a more detailed analysis of the drivers of variances, including offsetting factors. So, for example, if your SG&A expenses went up by a certain amount, and you're describing qualitatively that there were two factors, one of them offsetting, that led to that, they will often comment to provide information or quantitative information about each of those offsetting factors. And they'll do that for a variety of line items. It's not always revenue, for example. They will focus on that in terms of gross margin, SG&A, revenue, all various line items.
Research and development. I noticed a lot of comments in that area too.
Yeah. Oh yeah, definitely.
That's increased as well. So I mentioned revenue. There's some pretty explicit guidance about revenue and how revenue fluctuations might be impacted by the pricing changes, new products, volume changes as well. But really, that concept does really apply to all the line items. So that quantification is a comment that we see that's really the largest volume there. We also see. And when talking about that too, we also see impact of acquisitions. So if a company has an acquisition or a divestiture, they're also looking for potential quantification of that. And that's just another driver of the quantification comments.
Are we seeing people or companies try to provide pro forma results to show the impact, let's say, of an acquisition? Or do they try to just kind of dance around it and provide enough disclosure? I mean, obviously, there is the ability to provide some sort of pro forma discussion, right, in MD&A. Sure. But are we seeing that a lot, or is it?
For the most part, where it's material or when a comment is given to do that, we'll usually see it just embedded in the overall discussion of the fluctuation. I think some companies may disclose changes in line items on an organic basis, right? Which is one way to accomplish that. But we do from time to time see companies that do take advantage of the ability to provide supplemental pro forma information to give readers the effect of what it would look like if this business had been, say, acquired earlier, right? But in those cases, it's pretty clear that it always needs to be supplemental. But we do
and comply with Article 11.
Yeah, that's right. That's right. And we see that from time to time, but it's not something I'd say is routine.
Yeah. And when we see a combined, let's say MD&A, or instead of truly pro forma under Article 11, but someone's trying to combine businesses, maybe they had a bankruptcy and it's a restart or whatever, we'll see the SEC staff sometimes comment about that if they're just providing that without the real MD&A, the historical results.
Right.
I know when I was perusing through the comments, I did see one of those this year. It's not something you see frequently, but there was one.
So to your point, right, about providing it as a supplement. So I'm glad you highlighted that, right, because this is in addition to the historical. You have to discuss your historical results. What you've presented in your financial statements. That's helpful. Anything else? One thing, Ryan, that I know you wanted to mention is really something that popped in my head earlier when you were talking, and it was surrounding just all the information that's in investor decks, presentations. And when you think about the staff, like they're going to look at that, they start to hone in on, there's performance metrics, or there's information in the earnings release. How are these key performance indicators being discussed or described in MD&A? Are we seeing a lot of comments on that with respect to results of operations today?
We are. That's a fairly typical comment where they will notice that in press releases or investor decks, companies will talk about certain key metrics. They will provide it in a comparative format. They'll perhaps give some additional color about how it's driving the results. But then say you look to the MD&A and those metrics are not there. They're not disclosed. And so the staff will issue comments asking companies essentially to reconcile or, please tell us how you considered whether or not that's material information that's required to be disclosed, because there is guidance out there that would indicate if it's material to an understanding of the business and it would be material to investors, then there are key metrics that they would say are de facto almost required to be disclosed.
And that's commission guidance. That's not staff guidance at the SEC. And commission guidance has a different level to it. It is actually the commission speaking of their interpretation of MD&A for the performance metrics.
That's a good point.
And I know this weekend, I actually, as part of my time cooking, I listened to our non-GAAP podcast, which was great. So plug for that. But they talked about key performance metrics versus non-GAAP measures. So I encourage people to go to that because there is this requirement or this commission guidance about performance metrics, but that's different than non-GAAP.
Yeah. So Lindsay, I want to stick with you for a minute here. And really it's largely due to the fact you were previously at the SEC very recently. You have spent time, looking and seeing and probably working on Dear Issuer letters that they call them on various topics. So I think broadly about just any of the macroeconomic condition, geopolitical events, things going on around the world. And you think today, right, about those things and it impacting the operations, tariffs, inflation, interest rates. Can you talk a little bit about, where within MD&A might we see a discussion of these events? Obviously in results, right? But then also where else?
Yes. So maybe let's level set on what we saw from companies' disclosure and MD&A. What were the events or macro, or I always say it's the current events or events outside the control of the company is the key here. And so we saw companies talk about interest rates, the tightening of credit conditions, inflation, supply chain disruptions and logistics, tight labor markets and wage talent pressures, ongoing geopolitical tensions, the tariffs and the changes throughout the year on trade policy in the U.S. and other jurisdictions, natural disasters, foreign currency volatility and cross-border exposures, and tax and regulatory changes. That's a lot of events. And so when you're a company and you're trying to approach your MD&A, you have to consider all of those if it's applicable to your business. And so what I think the important thing to kind of break it down of when you have this laundry list of major events that you have to consider, and I'm going to draft my 2025 10K and do my MD&A, what do I spend the most time and effort on and what do I need to disclose? I would break down MD&A by first is which of those items actually impacted your historical results and kind of put those on one side that you need to assess. And then which of those items could impact your business. And the reason why I kind of separate it that way is we know from what Ryan described, you have to talk about your results of operation, your historical periods. But MD&A also has the concept of trends and uncertainties and the concept of, what could impact, what could make my historical results no longer be reflective of what it's going to look like in the future. And a few key things in the disclosure requirements for MD&A, when you think of these events, once you kind of bucketed it to say, these are the events that did impact historical or may impact in the future, then you go to, well, which of these do I actually have to talk about? And so let's say you narrow it down to like 3 items. Well, now you have to think, are these items material? Obviously, you know about them because that's a key part of MD&A is that it's known to management, the event, because you wouldn't have been able to list them out if you didn't know about them. But then also, is it reasonably likely, based on management's assessment, that event would have a material impact on future operations? So when the staff revised MD&A in 2020, there was a few additional words put into MD&A on trends and uncertainties, and it was the inclusion of the word material in multiple places, but also the concept of it was always there, but I think there was more discussion in the release in 2020 about the reasonably likely based on management's assessment. And that's a lot of judgment. So management has to determine if something's material Is the impact expected to be material? Do I know about the event? And then is it reasonably likely? So there's a lot of judgment here from management on these geopolitical, macroeconomic, global, sector-related events that it's not within their control, but then they have to turn around and make several judgments of what to disclose. So I would just highlight that it's important for companies to probably have some robust policies and procedures here. You have your disclosure controls and procedures related to MD&A to kind of identify the events. As we approach year end, continuing to monitor all these events and how they may impact your business, because we all know things change quickly. We've definitely seen it. And a place to kind of look to for some maybe guidance of how would I address this in MD&A, any of these events, or forward looking, like I think it's going to maybe be reasonably likely to impact in the future. The SEC recently tagged on their website all the COVID-related guidance as no longer applicable. But they did not remove the guidance. So you were talking about, Kyle, the Dear Issuer letter. So CorpFin had issued some disclosure guidance topics, number 9 and 9A, specifically related to COVID. Well, for years after that, the staff and preparers looked to that guidance as remove the word pandemic, remove the word COVID, and
insert
replace
anything else.
Yeah. And so when I heard that the SEC was removing this guidance, I personally was worried, because I do think it's a good playbook for companies to use and see what would my comments be, what should I be thinking about. So I was pleasantly surprised and happy to see that while they tagged it as no longer applicable or relevant,
it's relevant.
But they left it on the website.
Yes,
So we all still have that. I think it's relative for companies to think about as it relates to that. Some other things I would just highlight quickly is I know there was a lot of talk of tariffs this year. We did see a few comments asking about more MD&A disclosure on tariffs, but maybe not as much as you would think for the amount of attention it received. I think companies probably did a good job of highlighting that it was going to be a risk possibly to future operations. The other thing is that it's also something that maybe affected certain sectors in different ways. As this continues with inflationary pressures, as interest rates, we're seeing their decline. So I think all of these are things that companies need to be considering at year end of how it's going to impact their business, making sure that they're not using boilerplate MD&A disclosures as it relates to trends and uncertainties. They have updated this information. Another thing is the SEC staff has really criticized companies for saying that it's a hypothetical risk to their business for one of these events, when really the event has occurred or it has impacted their business. Yeah. So that's another reminder.
Just on that point, when I'm looking at filings, and whether it's the risk factors or an MD&A, oftentimes when I'm reading it and I see things that'll say, we may be adversely affected or we may be impacted. I will often just circle the may and just make sure as a kind of as a service that was intentional language, and that they have not actually already been adversely impacted. Now, maybe it's not materially adversely affected, but that's something I see pop up quite a bit. And I think that is the focus of what Lindsay's talking about in some of the comments in that area.
Yeah, I think as I'm unpacking kind of everything that you just highlighted, Lindsay, it's the thing that I'm thinking in my mind is, look, changes in interest rates, right? Like, okay, there's a decline, right? Well, there has an impact, a lot of other impacts, right? When you think about discount rates being like, there's a lot to think about when you are looking at disclosures and other sections of the MD&A, critical accounting estimates, right? You're thinking about some of the assumptions, what you've used in models, growth rates, the impacts of tariffs on growth rates. And, so there's a lot of things that for companies to think about. And it kind of leads me to the next topic, which really is the liquidity. And Ryan, as people think about liquidity and capital resources, obviously the environment, there are companies that may be struggling in this environment. What have you seen there? What kinds of comments are we seeing?
So the liquidity and capital resources section requires disclosure of the material uncertainties surrounding companies' liquidity. really fundamentally what's your ability to meet your liquidity needs. And most of the comments, or a lot of the comments I see in this area, are really because perhaps the SEC views the disclosure to be very short-term focused as opposed to long-term focused. So there's a fair amount of comments that remind registrants that the discussion is supposed to be appropriately balanced between the current the short-term needs as well as those on a long-term basis. I often see comments in this area when there have been changes in the company's capital structure. So a new facility, or they'll note that potentially a revolving facility was maybe terminated and not replaced, right? You'll see comments, or at least focus in that area, to say, hey, how does that work when we look at your cash flow from operations? How are you balancing that on a short-term and a long-term basis? So a lot of the comments are in that area. If there's debt coming due in the near term, especially when we were dealing with a increasing interest rate environment, and the company's ability to refinance was maybe curtailed to some degree, or at least needed to be a little bit more focused on how to approach that. We did see a number of comments asking companies to explain a little better how they are going to deal, or what their prospects are for refinancing, or do they plan to finance that with cash from operations? And obviously that's going to vary depending on what your cash flow from operations has been recently. And then we do see in this area as well, on the cash flow statement, we'll see comments from the SEC that are asking companies to be a little bit more specific as to why cash flow from operations may have fluctuated from one period to another. They note in the comments often, and we talked about this last year, it's a continuing theme, that they'll say we don't merely just recite what's clearly evident from the indirect method of cash flow presentation. In other words, the fact that your depreciation was higher than what it was last year isn't a reason why your cash flow from operations has changed from period to period. So they'll ask companies to be a little bit more direct in describing why it may have fluctuated, which presents a little bit of an interesting challenge, because most companies do prepare and disclose their cash flow statements on an indirect basis.
Almost all companies, right?
So,
there's maybe one that doesn't.
Right. So companies have to be a little crafty in terms of how they get to that. So
yeah. So that's I'm glad you guys, you've done a nice job of kind of weaving in the requirements with kind of what we're seeing, like the conditions in the market. And so I want to move to an area that I've already mentioned a little bit, and I don't want to spend too much time on it in the interest of time. But I do think it obviously is a focus of something, Lindsay, that you and I both, when we worked at the staff, issued a lot of comments on. And it really was, whether it was accounting policy footnote disclosures, right, or the critical accounting estimates within MD&A, that was always an area of staff focus. What are we seeing? Are we seeing a lot of comments in that area still? Like, and if you can briefly, like, what's an example, or what do you think companies should be thinking about this year, and specifically where you think the staff may be focused?
Yeah. So level setting real quick, critical accounting estimates. It's an estimate made in accordance with GAAP that involve a significant level of estimation uncertainty and have had or are reasonably likely to have a material impact on the financial condition or results of operations of a restaurant. Common examples that we always talk about in this space is maybe your revenue recognition, your goodwill, and intangible asset impairment, valuation allowances for income taxes, stock-based compensation. These are things that are consistently coming up under critical accounting estimate disclosures. So I know last year we talked about how the SEC staff codified its 2003 commission interpretive guidance on critical accounting estimates in 2020. So it's now part of Regulation SK. Something interesting I noticed in the comments that were released in 2025 was that the SEC staff is still referring to the 2003 interpretive guidance.
Right.
As part of its critical accounting estimate comments. So I was a little shocked to see that, just because I thought that the actual 2020 release kind of addressed that, and then the codification. maybe under this new administration, we would see the SEC staff revisit the 1989, the 2003 Commission interpretive guidance on MD&A for reasons like this.
Yeah.
So that way, maybe they can condense it all into one updated interpretive guidance, because it does kind of sometimes create confusion for preparers as you receive a letter referring to older guidance when you know there's a new rule. You thought that you were complying with the rule. So I just want to highlight that of, don't be alarmed if you see reference to the 2003 rule. In a lot of ways, a lot of that interpretive guidance still applies under the new rule. And that's why you haven't seen the SEC repeal it. So we've definitely seen continued commenting on it. Most common areas really are your goodwill impairment, honestly, and intangible asset impairment. Yeah. And what we've seen with the macroeconomic events and all, it makes sense why we are seeing maybe more robust disclosures. Maybe there's more reporting units at risk. The SEC
changes in cash flows, changes in assumptions, right?
Yep. Yeah. The SEC has staff guidance out there in the financial reporting manual in section 9500 of if you have a goodwill reporting unit at risk, that you need to provide additional MD&A disclosure for that at-risk unit. So I point people to that.
I think that's a good reference point for people because it does provide good guidance.
And that's what the SEC staff's commenting on is those topics. Yeah. The only other thing that I would highlight in relation to the critical accounting estimate disclosure is when this was codified, again, there was maybe some additional language around the edges, similar to what I was highlighting with trends and uncertainties, with the use of terms such as, can you provide this information? Is the information available to you? So some of what the requirement is, you have to provide the assumptions and inputs related to your critical accounting estimates. But you only have to do that to the extent the information is material and reasonably available. Yeah. So again, there's that management judgment going in throughout management discussion and analysis. But it is possible we don't always see as much of what we thought the SEC staff might comment on in this area. In the actual disclosures, not as much quantitative information because, again, it's to the extent the information is material and reasonably available. So someone could conclude that some of that information isn't reasonably available to them. And so the last thing of comment trends for critical accounting estimates is the sensitivity of the reported amount to the methods, assumptions, and estimates underlining its calculation. That's taken directly from the SEC rule. And that is an area, sensitivity of estimates, that we do see the SEC continue to comment on. I know it's something that I saw when I was at the staff, not a lot of disclosure on sensitivity analysis. So I highlight that to say, maybe you don't need to provide it in every circumstance. Because again, you have to think it's material, is the information available. But anytime you might have an at-risk reporting unit, that's probably a place that the SEC wants to know if you were to change any of your key assumptions for your valuation of your reporting unit, what point do you reach impairment? So again, going back to that section 9500 of the FRM. The other thing, maybe I will add one more point of when I look forward to what the SEC staff might be commenting on, going back to my remarks on the macroeconomic events and everything. With tariffs, we did see companies maybe buying more inventory earlier in the year because they were trying to prepare for higher costs related to the tariffs. And so there might be heavy inventory. And so inventory valuations, is the SEC going to visit that this year? Because again, if you were buying up a lot of inventory earlier in the year, planning for this tariffs, is the value still going to be there? And then the other thing is in relation to tariffs and interest rate assumptions, like anything else that could affect your critical accounting estimates, I would expect the SEC will be thinking about that. Yep. And I look forward to the next month here. The SEC will be speaking at various venues. And I believe, Kyle, you're doing a podcast to share those remarks kind of live. So I think that we should listen out for that because I bet you they're going to cover a lot of this MD&A stuff.
Yeah, I mean, look, I think it's obviously interesting that, obviously a lot of great points there and good takeaways. I think as I think about, kind of the SEC, you mentioned this, alluded to this, that we expect to see some changes, right? And the focus on material disclosure. We've heard that from Chairman Atkins, a focus on ensuring that the information is grounded in the law, the securities laws, the requirements, that it is financial related material disclosure. And, even today, there was an op-ed or an opinion piece published in the Wall Street Journal. He visited the New York Stock Exchange. I think was going to visit the NASDAQ. So, obviously he's out on the trail and pushing this agenda, this approach. And so I think it's very important for our listeners, I think, to keep that in mind, that there potentially will be some changes. It's a changing environment. And so obviously the pendulum continues to swing back and forth. All right. So as we are wrapping this up, any tips, anything you wanted to share? I'll start with you, Ryan. Anything you want to share before we wrap this up? Any takeaways? Any advice for our listeners before year end?
Yeah, two things come to mind. One is, as you're coming into year end for our calendar year end companies out there, as you're coming into year end, thinking about when preparing the business section or other parts of the document, just paying particular attention to discussion about new offerings, revenue, changes in strategy, new income streams, anything that maybe doesn't, say, reconcile to what you've had in your MD&A before. So that another way of saying that is be careful just rolling forward your MD&A, making sure all of that fits together, because a lot of these comments, as I mentioned before, are focused on that. The other is, Lindsay mentioned a long list of things that have been happening in the world over the course of the past year or two. And I think that being mindful of those, using the withdrawn but still available on the SEC website, the Division of Corporation Finance Disclosure Guidance topics, using that as kind of a mental checklist, because as she said, it does the rules read to require an assessment. So I think using that as perhaps just part of a check to make sure that you've considered all of that and the impact it has had or could have, I think is an important exercise.
Yeah. Lindsay?
I've mentioned the financial reporting manual a few times, but I was mentioning that also because the SEC staff did update it this summer, and it included an update for the 2020 MD&A amendments. So I think everything there, they actually still refer to older interpretive guidance like the 2003. So that means that the SEC staff does feel that's still applicable. So going to look at maybe a fresh look at that topic 9 and the MD&A and the FRM and seeing maybe there's a few things, words were tweaked or whatever, but that still seems to apply. And they kind of confirmed that this summer. I think that's another place to look to.
Well, I think definitely a lot of great advice here. I want to thank you both again, Ryan, Lindsay, for a great podcast, and obviously an area, a topic that's of heavy interest to our audience.
Thanks for having me.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.